Okay, good afternoon, everybody. Welcome to this week's Geotalk. I'm very happy to introduce our speaker today. It's James Campbell. James has an honours degree in mining and exploration geology from the Royal School of Mines in London, Imperial College. He has an MBA with distinction from Durham University, and he's currently completing his doctorate at the Da Vinci Institute in South Africa, with the proposed title, A Conceptual Business Incubator Framework for Junior Mineral Exploration and Development with a Southern African Focus. In terms of James's career, he has 40 years of experience, 20 years as at a corporate Anglo-American and De Beers, working in exploration, mining and strategy. And for the past 20 years, he's been running junior listed exploration companies, and he's now into his fourth, Botswana Diamonds PLC, which is listed on both the London and Botswana stock exchanges. He is a professional member of the Geological Society of South Africa, as well as the South African Institute of Mining and Metallurgy. And in his spare time, he is the chairman of the Leadership Development non-profit organization Common Purpose South Africa, and also is a technical advisor to Shifa Gems in Israel. So thank you very much, James, for dropping by to give the talk. We're very excited. And personally, I just want to say thank you very much for all of the assistance with honours field trips over the last few years. James has been a great help arranging access to Marsfontein and being involved and contributing to our honours class. So thank you very much.
Thank you very much.
Look forward to your talk.
Thank you. Well, good afternoon, ladies and gentlemen. It's wonderful to actually do something physically, and I know we've got some people online, and good afternoon and welcome to you too as well. But it's such a pleasure doing these things face to face, because often when you give a presentation, you actually feed off the energy of the audience. So I will notice if you're on your phone going to sleep or doing any of these kind of things. So what I'm going to talk to you about today is a case study of a mine from the very beginning to where it is now. And I was just mentioning to Ben at the before we got started how rare it is to find such a thing. I'm going to be looking at some of the technology. I'm going to be looking at some of the economics at the times, some of the politics at the times, and why decisions were made. So I hope you'll find it interesting. What I'm about to say is in the public domain. And clearly, as you would imagine, as I go through the presentation, there's a backstory too, which I can't talk about for fear of having to go to jail or thereabouts. So I'm going to start my introduction. I'm going to give a very brief overview of the diamond market, just to set a bit of context. I'm going to talk about the discovery of what was called AK6 a long, long time ago, and I wasn't around at that point, although I have a lot of experience, but I wasn't around then. Its rediscovery in evaluation, mining, and some of the corporate elements that went into creating what is a magnificent mine. Then I'm going to conclude in terms of lessons learned. You would see the subtext of my presentation is learning the lessons of history. My mother was a historian, so she would be very pleased that I'm kind of weaving, trying to learn the lessons of history into this quite technical presentation. So firstly, where is the diamond market at the moment? Diamond market is in an awful place. It's in the worst place it's been in the 40 years since I've been involved with it. And it's basically because of two reasons. One, American consumers, American men want to buy their partners lab-grown diamonds and not natural diamonds. Now, cheapskates. And why I'm focusing on America is half the world's diamonds are sold in America, and half of them are sold between Thanksgiving and New Year. So it's particularly important, that market. And then secondly, under the management of Anglo-American, the marketing budget of De Beers has shrunk. When I used to work for De Beers 20 plus years ago, it was in the order of $240 million per annum. And now I can't find what it is in the Anglo-American annual report. Maybe there somewhere, but I would imagine it's a fraction of that. So what is going to change this? Well, firstly, lower volatility in world financial markets, a bit more certainty. Will that ever happen? I don't know. I don't believe it will. But more importantly, Anglo's been trying to sell De Beers for over a year now. and you know if you own a house and you have it on the market for over a year, it's unlikely to be sold, and if it is sold, it's going to be sold at a much lower price. So that's what's happening now. And once De Beers is free under an independent, strong management with a strong marketing focus, you'll then see the opposite of the graph on the top left-hand corner, and then a significant uptick. But my view, it's not going to change until that happens. Now, this is an important context for the rest of the presentation. So, where is AK6 or Karowe? It's in northeast Botswana. It's in probably one of the most significant economic kimberlite clusters in the world. A kimberlite is an extinct volcano. I don't need to go into the detailed geology. You are all geologists. But in this area, you have 85 kimberlites in the cluster, of which 8 are or have been diamond mines. And that's a very, very high percentage. Particularly if you look at, there are 6,000 kimberlites in the world roundabout, 600 of which contain diamonds, and of which 60 have been or are mines. So this has a much higher percentage of commercial kimberlites. It includes the world's largest, Arapa, 118 hectares, is the world's largest kimberlite mine. And the original version of this presentation was given at the 50th anniversary of the discovery of Arapa, and we are very, very blessed to have the discoverer of Arapa, Manfred Marks, come out from Australia to give the keynote presentation. He was 80-something, but still as sharp as they come, and as interested in the world of diamonds as he was 50 years ago when he discovered Arapa. So I'll always like to start with the end before I go back to the beginning, so you know what we're actually looking at. This is the Karowe Mine today. Beautiful backdrop of the Makadikadi pans and the flat expanse of the Kalahari in Botswana. It's a very large open cast operation, very, very efficient. But what is it famous for? It's famous for its large, exceptional diamonds. And you'll see this come through time and time again in this presentation. It's produced 6 diamonds over 1,000 carats, including an almost 2,500 carat stone. And if you look at the numbers at the bottom, 38 diamonds in excess of 300 carats, over 14 diamonds sold for over 10 million, which represents $276 million. And from a technical perspective, and we are a technical audience, this was excluded from the mineral resource estimate. And you'll see me coming back time and time again to this particular issue. So where does it sit in terms of profitability? People often blame a diamond man like myself by just giving pretty pictures of diamonds and how much they are worth. Yes, that's really important, but what is equally important is how much money does the mine take. It's paid over $271 million in dividends to date, including in its first year of operation. And if you go and do your research to find out how many mines of any commodity paid dividends in its first year, I think you'll find there are very, very few of them. So it's a highly, or was, a highly profitable mine. So let's go back to the very, very beginning, about the early diamond days in Botswana. I love lifting out a bit of history from some of the old-timers. Well, in 1929, there were rumours of diamonds being found in Botswana. And you can look at some of these ethnographic articles and look at some of these photographs about this mythical diamond field in the Kalahari. And interestingly, my priest in Felixstowe in Suffolk, who's long passed on now, was a Cub Scout and was part of this particular team. And he always used to tell me, did you find that deposit? No, I didn't. Manfred Marks did. But we found something very, very special too as well. So people have known about this for a long period of time. And if one looks at kimberlites and diamonds in Botswana in general, you can roughly see when they were found. 1959, the first diamonds were discovered at a place called Mudlutsi. These were alluvial diamonds. And then there was a rush of new discoveries. 1967, Arapa and Dumpsha, which is a close-by operation. 1969, Letlakane, also in the Arapa area. And then the kimberlites around Jwaneng in 1972. Jwaneng is, they call, the Prince of Mines. It's one of the mines with the highest profit to revenue ratio of any mine known actually on the planet. So Botswana is very rich in kimberlites, very rich in diamonds, and from diamonds they've built a model democracy. But it's beyond the ambit of my talk to talk about how good diamonds have been to Botswana and how wonderful custodians the Botswana have been of diamonds. So let's go back to the very beginning. It was discovered in 1969 by De Beers, and you can see one of the kind of the diagrams of AK6 at that time. It was delineated during the course of 72 to 75 using drilling, and the results of that drilling and assessment found a small kimberlite, just over 3 hectares, and low diamond grade of 3.5 carats per 100 tons. So it was considered low interest, and clearly with what I mentioned in my slide before about the discovery of Droneng, Letlhakane, Arapa, and all the other kimberlites, this would of course not be of much interest. So it was basically abandoned until the turn of the century. If I look at that in context as well, because it wasn't just the geophysics which showed a small size, and the drilling which gave a low diamond grade, the number of garnets taken for mineral chemistry analysis was too small. We only know about that later, and it showed very little, if any, garnet sitting in the subcalcic field, which basically indicates it sampled the mantle and had potential for diamonds. You'll see that on the left-hand side plot, and on the right-hand side plot you will see once you have a larger population which sampled the kimberlite, not the basalt, because clearly the basalt will contain no kimberlitic garnets, you started to get garnets coming in to the subcalcic zone, which is obvious if you look at the large diamonds that it now kind of produced. The fourth bullet is a really important bullet, excessive diamond breakage using cable tool or jumper drilling. Now, many of you are probably way too young to remember cable drilling, but it was basically like a stomper. It was like a hammer going onto the kimberlite. And you can imagine just how many diamonds that actually broke, and the considerable underestimation of diamond grade and diamond value. Let's also look at the economic context of the 1970s and 80s. And often we forget about why decisions were made at a particular point in time. They are not made in isolation. The decision around AK6 was not made because of just AK6 and the other kimberlite discoveries at that time, but was made because of lots of other things going on. There was a period of economic stagflation, high inflation and unemployment, an Arab oil embargo, and just look at the 2 major stock exchange crashes. We've experienced that during COVID. We've experienced that during the global financial crisis. You're all young enough to remember both of these, but these were far more significant. Something which people are forecasting may take place in the not too distant future. Debswana was formed, which is a joint venture which manages these diamond operations in Botswana, and it was a decade of big mine opening. So clearly this was what the appetite was for large, high-grade kimberlites rather than these smaller fish. And De Beers was listed at that time, and if it was listed now, which it isn't, it would closely follow the Dow Jones Index. And that's unsurprising because many kind of blue chip and bellwether stocks do that. So it was a difficult time. We often think today it's never been more volatile or there's never been so much change. At that time, they thought the same too as well, and just look at the economic and political consequences actually of that. And this is important to bear in mind the decisions made by the people who controlled these interests at that point in time. So fast forward to the rediscovery. I call it a rediscovery because it was discovered before, but we went back there, and I was part of the team which went back there. It was granted a license to look at this particular kimberlite, plus many, many other kimberlites in the area. And you'll see I use an old adage later on in the presentation, and that is whenever there is a paradigm shift in technology, your exploration clock starts ticking again. And you go back and look at old areas. And the 2 things which were pivotal here were firstly brand new geophysical techniques, which showed that it wasn't 3.5 hectares anymore, but was actually much larger, 9.5 hectares. And then new drilling technologies in particular something called reverse flood drilling, where diamond breakage was significantly less. There was still diamond breakage, but that's significantly less than what it was in the olden days. And so based on these two elements, the decision was made to go forward. And I'm going to be talking about the evaluation in a little bit more detail, as it's a technical focus of this work. So the first phase was what they called initial evaluation. This was using the SAMREC code exploration results still, and it used fairly elementary drilling and geophysics, but it gave a size of 9.5 hectares. It confirmed what was going on, and it gave a grade of 25 carats per 100 tons. Remember that number. Often they say that at this point in a potential mine's history, you know whether it's going to be a mine or not. And if you've been around long enough in this kind of environment, you actually do know it. And we knew at that point in time, with that kind of grade, that it was going to be a great mine. Bullet point number 3 is a particularly important thing, and you'll see that I come back to, that the joint venture with African Diamonds, which I became managing director of, was formed before the results were known from this drilling campaign. You might want to think about that a bit later on and why that was important. Anyway, based on these results, the decision was made to continue, and this particular phase was geared around defining the inferred resource. We moved from standard percussion drilling to large diameter drilling, which is 23-inch drilling using reverse flood and something called an elephant rig. A picture of the elephant rig is the middle picture there. Core rig is in the top, and there is the bulk sampling plant actually on site. So you can begin to see the amount of money and work that's actually going to go into this. Have a look at that grade number. That grade number hasn't changed. Even with sampling just under 3,000 tons, we're still sitting at 25 carats per 100 tons. And this whole phase of work was defined to give an inferred resource. Clearly, this was good. And the next phase was agreed upon, which was to define an indicated resource. Now, why is that important? Is you need to have an indicated resource to deliver a bankable feasibility study, which means you can raise finance to actually build the mine, unless you fund it through pure equity. And because this was a joint venture with a junior partner being African Diamonds, we needed to look at bank financing. Again, the numbers are all fairly similar, but here's an interesting point. The third one is the final phase in this evaluation was bulk sampling on the surface. Core drilling was used to give your geological definition and your density estimates. Large diameter drilling was used to give you your 3-dimensional grade estimates. But in order to minimize diamond damage, bulk sampling was done on the surface to extract diamonds for a valuation. And that part is one of the most important concepts in resource assessment. You'll see a layout of the diamonds in the bottom right-hand corner. But you'll see my comment there that we only recovered 1,700 carats against 3,500 carats. And SAMREC and other codes talks about a minimum 3,000 carats to achieve an indicated mineral resource. Otherwise, you don't have a bankable deposit. That's a really important point, and I'm going to come back to that shortly. And if one looks at the techno-economic studies, I'm going to give you a broad flavor of some of these things, and Ben has a copy of the presentation and can share it. But what I want you to do is just look down the net present value column. Net present value, I'm not sure if you do discounted cash flow during your degree, but basically gives the valuation of that particular deposit. It's like buying, it's the equivalent of an asset value for a house, for example. And you can see everything there from -70 to plus $209 million. So how on earth do you think people are going to make a decision with this? We've done all this technical work, which I've just been chatting about now, the drilling, the bulk sampling, and you name it, and we've got these massive variations in diamond value. Why? Firstly, very large differences in capital. Look at the penultimate column there. Anything from $88 million to $380 million to actually build the mine. For the same thing, And I'm going to be talking about that in a moment. And you'll also see in the super text there, points number 1 and number 2, is the difference between the 25.5 million and the 189 million is different diamond values for the assortment. You might ask, well, isn't a diamond value a diamond value a diamond value? No, it isn't. It depends on how you sell them and how you estimate them. And I'm going to be talking about those two in a little bit more detail. And that might sound, gosh, that's so technical. Yes, it is so technical, but look at the vast difference in valuations. It just shows you how important it is to get it technically right. If you look at the resource statements, again, you don't need to look at the exact numbers here. I'm more interested if you actually look at the trends going through here. You look at the dollar per carat trend in the last column, starting off at 130, 150, 190, 180. Just to remember those numbers when I talk about what the production numbers actually happen to be when I get onto the production section. So let's go into mining, and this is actually where I'll share with you what the results of this evaluation process. So what actually came to pass? Well, this is an aerial view of the mine site. I've already shared with you a photograph, an oblique photograph. It had a very modern, very low footprint processing plant, and it's an extremely well managed operation. But you won't be able to read the detail on this, but here the mine achieved its production forecasts every single year. You'll see the grades were a little bit lower than the 25 CPHT. That was at a bottom cutoff of 1 millimeter, but they were using a bottom cutoff of 1.5 millimeters. That means there will be a lower grade, but a higher dollar per carat. And if you look at the sales average dollar per carat, that's a number I'd like you to remember, in particular compared to the 130 to 180 I shared with you a moment ago. And you can see 270, 415, 600. So we're looking at a multiple in mining of 3 times the diamond value, which was achieved from the resource assessment. Why? I'm going to be answering those questions shortly. Just look at the magnificent diamonds. If one looks at the importance of large diamond production to this mine, then it is rare. There's only one other equivalent, and that's even more extreme than this, and that's let's say in Lesotho, that 60 to 70% of the revenue comes from 5 to 7% of the weight of the diamond. So it is one of the most extraordinary plus 10 carat producers of diamonds in the world. And when you are doing your assessment and your evaluation, it is so difficult to recover them because they are very rare because of their infrequent abundance in the kimberlite, and because of your technology which you are using to assess the resource being drilling. I'm going to come on to some of these points and why. The mine is still going strong now. It's interesting. It shows one's age. You can talk about the exploration, the rediscovery, the surface mining, and now it's going underground. And then it'll have a life of mine to about 2041. And this is an underground schematic using sub-level caving, which is fairly standard for any kind of kimberlite operation. And I've just put these slides in here just to show you where the kind of current thinking is at the moment. From a corporate perspective, I want to give you some of an idea of what was actually going on in the background. Well, firstly, I've talked about the advent of new technology. Both De Beers, prospecting Botswana, and African Diamonds had contiguous land holdings, so it made sense to put the two together. And here you have a large corporate joint ventured with a small Botswana Stock Exchange and London AIM listed junior. De Beers was the operator at 51%, but they could earn in 70% by delivering a bankable feasibility study. Just remember what I said about the 1,700 carats which were recovered from the bulk sampling, which was not sufficient to deliver a bankable feasibility study. There's a lot of detail on this, but I'm just going to bring out the highlights because these were fundamental points. The third one in bold takes off from what I was just saying now, is De Beers did all of this work because they were the operator. They wanted then to declare the deposit was bankable, so they could go from 51 to 70%. it wasn't bankable because there wasn't sufficient carats on the bulk sampling. So in order for it to be bankable, someone had to be the bank. So then De Beers agreed to be the bank. So it didn't matter whether it was an indicated resource or not, because it wasn't at that particular point. So bankable has a technical connotation, but it also has a commercial connotation too as well. The next one was where I lost a lot of gray hair. I've got to be lost a lot of hair, and I got gray hair at this particular point, is that De Beers felt that it was not going to be economic, the mine, for various technical reasons. And we felt that it was going to be a mine. Just remember the net difference in net present values, which I spoke about earlier. So De Beers applied for a retention license to basically block it. We launched a high court action in Botswana against them. And the long and the short of it is that retention license was withdrawn and a mining license was granted. Just imagine if that retention license had been granted, that mine would never have been opened and would probably, especially in today's market, would have been completely forgotten about. And then the penultimate point is that during the global financial crisis, De Beers couldn't fund the $380 million to actually build the mine. So they said to us, go and find a buyer. That's a bit like trying to find a buyer in the diamond market now. No, we had no money. No one had any money. It was a global financial crisis. We ran for many months without any money until we came across, I call him an insider because I can't say who he is. You might better work it out who he is. An insider in Lucara who wrote a personal check to De Beers. That process took from getting to meet the person through to writing that check took only 2 weeks. That's all it was, including a lot of red wine and stuff like that. Anyway, but he made it known that he wanted 100% of this and he would buy us out, which he eventually did, and he bought us out for a 30% premium. So the mine is owned by Lucara Diamond Corp, but you'll see a bit later on about economic returns, which is probably my most important slide in the whole deck. It was not without its drama. I just put this in there for a bit of fun. There's something called Rainmakers and Pot Stirrers, and Roger and Ben and others and Linda may have been around at the time, but it was almost front page news almost every other week. It's like a David and Goliath, especially in that I'd spent 20 years at De Beers and was now running a junior. But of course I understood how diamond projects work and how diamond businesses work. So it was a terrible... It's never a good mine without a thumping legal case somewhere in the middle of it. And here's a good example. And there are many good examples here, which you can follow in other mining ventures. So what are the lessons learned from this? Firstly, the economic context. I've spoken about 2009 being the global financial crisis. It was called annus horribilis, a Latin word for it. And just look at the diabolical results. 99% drop in profits by De Beers. You think it's bad now. I think they lost $189 million this year, but it's nowhere near as bad as it was in that particular point in time. Global workforce cut, sales of rough diamonds cut. It was a really, really bad time. So you can imagine why De Beers was reticent to actually spend the $380 million they identified for building the mine. Investors were reluctant to find things. Mining boom ground to a halt. Juniors, which I was running, were the hardest hit. So I spent 6 months almost begging people to come and invest in what was going to be the next best diamond project. Because A, they simply didn't believe you. Who were you anyway? What would you know? And secondly, they had no money because it was the end of the world. And people saw it being the end of the world, 2009. But as we know, people are resilient, companies are resilient, countries are resilient, and we kind of bounce back quite quickly. A joint venture dynamics, of course, this is a really important thing. And if you ever run joint ventures, often it's between a big corporate and a small junior. It is difficult. You have different risk appetites, different approaches to capital. You've seen that. I've given you examples of that. Different approaches to financing, different hurdle rates. The Anglo-American De Beers hurdle rate would have come down from on high from the board. You know, our hurdle rate, my chairman is a doctor of economics. He would determine what that was, and it would actually be a lot lower. Decision-making processes were very different. We could have a board meeting at the drop of a hat if we decided to. The board meetings for large corporates take place on a quarterly basis, and there's a long process behind it. And quite rightly so, because they have a lot more complexity to actually manage. The other really important point, and that's come through time and again, is we had local shareholders. 20% of African Diamonds was owned by Botswana, mostly high net worth individuals in Botswana who are very vocal. And quite rightly so. It is in their country, and they wanted to get a benefit from that. And we had good relationships with them. And I think partly this was one of our secret weapons. We were a tiny little company compared to De Beers at the time. But because we had people investing in us directly, normal people, we had a groundswell of opinion actually supporting us in Botswana. Some of the technical considerations. I've already commented about the significant developments in technology leading to the rediscovery. And I have to find a reference to that, and the reference is Dr. Mark Bristow here, but I'm sure it's come by many other people. The diamond breakage, and it's still an important issue in resource assessment today, and an improved understanding of diamond size frequency curves, particularly in terms of diamond valuation. I made a comment earlier about there are two, and there are many other members in between areas of how you value diamonds. You have a price book, which is used by the major producers, where if it's a 10 carat VVS1, that's what it is. Or you have open tender. And that is, let's say you are all going to buy from me, I'll give it to the person who's going to give me the most diamonds. And you might think they are the same, but when markets are running, i.e. prices going up, typically your tender process offers 15 to 20% premium over a price book. And the corollary is true when markets are going down at the moment, in that your open tenders will give you a lower price than the price book. And if you read a little bit about diamond pricing in the market at the moment, you'll see that the latter point is particularly important. And my penultimate point here is an absolutism. The diamond value is significantly underestimated in the financial modeling. It started off at $134 a carat. The best estimates at that time were nudging 200, 180, 190. But I mentioned it's been between $400 and $600 a carat. And that's because of the abundance of large type 2 diamonds, which were very difficult to estimate. The geological model, I wanted to put this in so you could actually see how it changed from 2006 to 2013. Essentially, you're still looking at the same shapes, but a different level of granularity in terms of the different kimberlite phases and the different waste phases too as well. If one looks at the mineral resource, there's your value goes up. If you look at the purple line in particular, your diamond value hovering in the low hundreds and then nudging at 400 once you started to get more detailed information. Economic value, I think this is probably one of the most important slides in the whole deck. And why is it? Is that the original investors in African Diamonds, public company investors, made 25 times their money on this project. If you're an original private investor, so basically you put in pre-IPO money, you would have made 90 times your value. Lucara has also done exceptionally well. They've had a 40 times increase in market cap. I scratch my head a little bit on that because it actually doesn't, size doesn't mean anything here. And often I tell this to people in the mining industry, is that what matters is the price of your share. Because if you're buying 100 shares from me and you're priced at a rand, you don't care if there are 1,000 shares or 100,000 shares. You don't care. What you care is your rand is going to be worth 10 rand a share. And that's such an important thing. So if you get mining people coming to talk to you about, oh, I run a 5 billion or 10 billion market cap company, yeah, bully for them. That's great. But what kind of share price performance have they given to their ordinary investors like people like us. Sadly, things have drifted. You'll see that Lucara was valued at $1.2 billion. At the time of the acquisition, it's worth $100 million now. And that's just a reflection on the state of the diamond market. If you're interested in this kind of thing, the graph of African diamonds there in the yellow closely follows that of something called the Lassonde curve, which is a classic way of looking at junior company evaluation. And in fact, this is almost textbook junior company success in a way, which is great. So some of the corporate lessons, I've mentioned about the different agendas between the two joint venture partners. I spoke about the importance of the local listing and the importance of local ownership in mines. And I'm not talking about local ownership here in terms of regulatory ownership, because that's all that we really understand here. I'm talking about entrepreneurs who put their money in and want a return. And it's, you know, there's a fundamental difference between the two. The insider at Lucara was able to buy because he had cash. Cash is king. It always is when you do acquisitions, and the fundamental difference in diamond pricing methodologies. And then from a technical point, if you want to kind of distill it to two points. Firstly, that bulk sample was just too small. If 3,500 carats was recovered, double what was recovered, we may have been able to start to see some of those large type 2 diamonds and give us more evidence. But the final bullet point here is the importance of qualitative information. I've given you the numbers which were published, but there is an SIMM paper. It's referenced in this Institute of Earth Sciences report, which actually talks about large type 2 diamonds being put together because they were broken from the drilling process. And we knew at that point in time, way before any of these economics came out, that it had the potential, because we had a doctor of diamonds who Kara knows very well, who actually put these diamonds together and said, right, this 57 broken pieces was actually a 25 carat stone, but because we had a 12mm top cutoff, we'd broken them. So the qualitative knowledge was there. We knew it, but we couldn't prove it at the time. Personal lessons, I put this in because I think it's important, because I hope some of you are going to go into the junior mining industry. It's going to be the engine of growth for mining in South Africa. Sadly, we have very, very few, and that's why we're not doing too well at the moment. Firstly, be prepared to fight a tough legal case against a much bigger and well-funded opponent. Have thick enough skin. One Sunday Times, it had a picture of me with the word traitor underneath it. Why? Because I was an executive at De Beers for many years, but I had different shareholders now. My shareholders were investors from the UK and from Botswana. From a financial perspective, and the corporate guys don't quite understand this, we had no money for 6 months, or maybe even 8, I can't remember. The wife just started asking, do you have a salary check at the end of the month? Because the answer was no. So you've got to find a way to actually kind of get through this. The third last bullet point, and here's an interesting one. How were we able to technically understand this better than a corporate? We used the absolute best people in the business, the best geologists, the best metallurgists, the best mining engineers. And these people tend to be maverick, and they tend to run their own little kind of companies, because they don't quite fit in to the bigger mold, but they happen to be absolutely brilliant. And one of them, I'll mention his name, and is Dr. Kurt Peterson, who revolutionized the design of the processing plant, which was one of the fundamental drivers behind taking that $380 million to around about $120 million. And it needs people, like that, who have brains the size of planets to think laterally, to deliver something. And then people like us to trust in their judgment, and trust in your judgment that they get it right. And my motto for this is never say die, never give up. So thank you very much indeed, Ben, and ladies and gentlemen, for your time.
Thank you, James. Fascinating insights into Karowe. we have any questions from the audience in the room? Also invite those listening online to raise your hands. Start with Ray.
Fascinating talk. Just a question about the process of the question. Do you use special to avoid the likelihood of
It's a very good question. From a sampling plant phase, it's incredibly difficult because you use smaller equipment such as jaw crushers and cone crushers. A jaw crusher could easily break a diamond because of that action. A cone crusher would break less diamonds. But what Karowe did from a production perspective is they used an autogenous mill. So basically they used the harder basalt to grind away the softer kimberlite to release the diamonds, which minimize diamond breakage. Maybe at some point in time, somebody will invent a much, much smaller autogenous mill, which you could use for sampling, and that would be the best possible case. But no one's done it yet.
Oh, didn't realize it was mobile.
Or I'll repeat the question.
I think it's fine now.
We had a top cutoff of 12 millimeters in our bulk sampling, and that was driven chiefly by the size of the equipment. For example, in your dense media separation plant, you would use a 200 millimeter cyclone, and a 200 millimeter cyclone dealt with throughput at that particular rate, but could only handle a minus 12 millimeter particle. If you wanted to go to a 25 millimeter bottom cutoff, for example, you would need then a 350 millimeter or larger cyclone, which would mean a massive multiple in terms of equipment, and you would be no longer looking at a 10 ton per hour plant, but a 50 ton per hour plant. So it just wasn't seen to be done at that time, and we would rely on the data to actually do the extrapolation. So with an autogenous mill, you can have a 50 millimeter, a 75 millimeter top cutoff and keep it going and keep recovering. And particularly the work they've done under the large diamond recovery unit. That has been fantastic. And particularly using technology like X-ray tomography too as well. But the challenge here, if I look back on it, is the people who had been around long enough, and I'm trying not to be ageist here, who had seen mines develop, like Venetia. All of you would have heard of Venetia. When I joined De Beers, it was considered submarginal. And De Beers has been, Venetia has been the flagship mine of De Beers for many, many, many years. And witnessed what happens in history during these things. People like Dr. Chin and others, myself and my boss, Bill McKechnie at the time, all knew that this would actually happen. But it was a judgment. It was a professional judgment. And if I look at my world in the junior world, yes, I have to have competent persons report, SAMREC compliant, etc. But I am allowed to apply judgment to it. And investors can choose to believe or not. And I think that level of judgment just was not taken cognizance of at that particular point in time.
Another mine like like Karowe, is a huge challenge because these large diamonds are from the sublithospheric mantle, and most diamond indicator minerals are lithospheric.
So there's a fundamental mismatch in that we don't have the ability to tailor our diamond exploration models for these types of mines that have super large diamonds because they're sublithospheric, but the indicator minerals all come from the lithosphere. And so that's a huge challenge, I think, that our industry is facing, is how do we find more of these mines and how can we tailor our exploration methods for that?
If I could just add one thing to that, Karen, if the diamond market was doing really well and we were able to raise money for diamond exploration, that would be one area of research that I think even a company like Botswana Diamonds would look to fund. The other area is how can we determine from trace elements or from kimberlite indicators whether they're going to be a high abundance of colored stones. Because if you can de-risk as much as you can right at the very beginning and not go through all of that sampling stage, you can get rid of, you can sort the wheat from the chaff actually much earlier. And my board is often on me on this a year or two ago. Now, can you tell if this has got green diamonds? I said, no. I'll try my best.
Any more Grant?
Question online.
Oh, I thought you were putting your hand up. We have two online questions. The first, Pete Roberts. Please comment on the threat of synthetic diamonds.
I briefly made a comment on that right at the very beginning, is that the synthetic diamonds or lab-grown diamonds have taken a significant role in the American consumer's eyes. So how can it be countered? It can be countered by very, very strong marketing. Let me give an analogy. Ladies, you might like your Louis Vuitton handbags, but you'd want a new one. You'd want someone made by Louis Vuitton, wouldn't you? You wouldn't want maybe a cheap and cheerful Chinese fake, would you? No. Good. That demonstrates my point. So whoever is the new owner of De Beers will have to spend a lot of money on marketing and basically celebrating. You don't start the beginning of what could be or should be a lifetime relationship on the back of something which was made in an industrial press. For goodness sake. But I'm unashamedly diamond mad. Okay.
I mean, I don't know the industry very well, but I just remember that didn't De Beers at some point have their own synthetic company?
Yes.
It's like it's counterintuitive to the whole marketing pitch that De Beers was trying to put out there.
Yes, now you put me into a corner now, but I have given this view publicly. I'm slightly careful how I say this one. Yes, you're absolutely right. De Beers had a large industrial diamond division, and they launched an initiative called Lightbox about marketing industrial diamonds into the luxury growth, luxury jewelry industry. My previous chairman, who I was his personal assistant, Nicky Oppenheimer, would have said, over my dead body, because you're mixing up in the eyes of the consumer two things. All credit to the new De Beers CEO, Al Cook, who's taken that off and has said it was a mistake. Yes, it was a mistake. That let the cat out of the bag, basically.
Because my understanding when I was still at GIA was that the word on the street was that they were trying to lower the prices of lab-growns to where they think it should be, because the Lightbox diamonds were significantly cheaper than many of the other lab-grown goods that were on the market at the time. And since then, lab-grown prices have come down significantly. So, yeah.
That's perhaps maybe more sophisticated reason, but in the eyes of the consumer, and that's all that really matters, you can suddenly get a beautiful lab-grown diamonds, which the world's top diamond company agrees is a good thing, is a lab-grown diamond. Yes, I get the argument around segmentation. I get the argument around, dropping the price of lab-grown diamonds. But the fundamental result of this was quite a significant drop in the natural diamond market, natural diamond prices. And I think if people were to write case studies on this in a year or three's time, they would give exactly what you said. But what is the overriding cause behind this drop in natural diamond price? It was that it was okay to buy a nice pink lab-grown diamond from Lightbox as an engagement ring, which it's not.
We'll just jump to the questions online, just take two more. We have Sentley, how do you incorporate the uncertainty of large diamonds during the valuation, especially in low-grade life deposits, such as those in the Lesotho?
Okay, there's a technical answer and a financial answer there. I'd say this is still very much work in progress. The technical answer, one of the things that we did, aside from the great work done by Dr. Chin, is we used a guy by the name of Dr. Paddy Lawless, who developed a very, very complicated mathematical model following the analysis of breakage using various classifications on diamonds to rebuild the diamond size frequency curve. Now, we were told I was accused of using voodoo science when I looked at things like this, but it's now pretty much mainstream, okay? So that is work that can be done. And the second part is actually, from a financing perspective, is you only need an indicated resource if you're using bank money. If you believe there's going to be large diamonds and you can have access to equity, you don't need to necessarily prove it up front. You can actually just use owner's equity to build the mine.
And then just take a final question from Nick Arndt online.
Ooh.
Could you say something about how Botswana benefits from the diamond mines? Is it really a country that has escaped the resources curse?
What a super question. Yeah, Botswana's always been seen as the paragon of democracy, the Switzerland of Africa, and indeed it is actually all of that. And they've been able to develop, you know, a terrific model of governance, terrific healthcare, terrific schooling. But what they haven't done is they have not diversified. And irrespective about what's happened with lab-grown diamonds and the lack of marketing in the diamond space, when a mine starts entering its second half of its life, you know, it's a bit like people like myself and maybe one or two others, is you get older and things get more costly. So this was always going to happen. So I don't see this as being a resource curse at all. There's going to have to be some form of creative solution to deal with the huge dependence and the huge expectations around diamonds in Botswana. Now, here's a very interesting kind of add-on I'd like to make. Why is it that Botswana doesn't have, talk about 2 years ago now, not now, the kind of junior level of activity in the diamond sector space, or what we call the small-scale operators? They have a royalty. They have a 10% royalty, which means that you go and run a mine there, you give 10% to the government straight away. So if you've got a profit to revenue ratio of only 20%, you're giving half of your profit straight away to the government. South Africa, many people complain about lots of things here. Now that's fine. Doesn't have it. They have a profit-based royalty. So if you don't make a profit, you don't pay a royalty. And that's one of the fundamental drivers around encouraging small-scale mine development. And those are the kind of things, not just in diamonds, but in gold and copper and iron ore and perhaps PGMs, which Botswana is blessed with, the government needs to look at to incentivize entrepreneurial mining activity in the country. And it can be done.
Okay, James, thank you very much for the Geotalk. Let's have a round of applause. Thank you. Okay. I'm sure.